Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And today is Saturday, and we'll call this Velocity Banking Saturday Study Camp, right? And I was wondering, like, let's say I actually did have a camp where all you did was just do spreadsheets over and over again. I wonder how many people would pay for that. But luckily, I'm too lazy to actually do that. So that's why I just upload YouTube videos and do everything online. But we'll just call this online Saturday study camp. So for all of you who are going to spend your Saturday here to learn about velocity bankings or need a refresher, congratulations. Because most people don't even know about the concept, right? So you're going to learn how to pay off debt quickly using the bank's existing tools. Okay. So the objective for today is kind of similar to other situations where we have a ton of credit card debt compared to our income and we have a mortgage. And so last time I think we went over over 100K, person who made about 115K and still paycheck to paycheck. Now we're going to go about 91K gross. And what's funny is that, once you make over a certain limit, the more money that you make, they call this like marginal tax rates, the more higher taxes that you pay as an employee. So you don't really get that much bang for your buck, the more money that you make. So obviously, it is better to make more money, but just be aware that at certain points, the more money you make, the more you pay in taxes, unless you apply certain tax strategies. Now, talk to your CPA, of course, because I'm not a financial advisor. I'm not a CPA. I don't know anything about taxes. So, I'm not giving you tax advice, but I think just as a general rule, you should just kind of be aware of that, which is why when you make more money, you don't feel like you're getting any bang for your buck. In fact, you get like a $10,000 raise at certain points. Like, what am I getting? An extra $100, $200 a month, right? So it doesn't seem like that much as an employee. But let's just assume that we make $91,000 gross. We have these four credit cards, right? So we have about $60,000 of debt and or credit card debt, and we have a mortgage, and we just want to know how to pay this off. So what's our objective for today? Pay off $60,000 of credit card debt, and we'll tackle the mortgage last, right? And so what are the requirements for Velocity Banking? We always have to say the same two things over and over again. We need a budget, which we have. It's kind of half completed. Complete this side first, and then we're going to complete the next side after we select our line of credit as our operating account. So what's the difference between the average American versus the person who does velocity banking? Average American uses their checking account to pay everything, whereas a velocity banker is going to use your line of credit as their main operating account, right? So I don't know about you, but if you made this income and you had all this debt, right, and you had this little tiny $250 savings, would you be sweating? I think I'd be sweating, right? but but now we're gonna do velocity banking here. So always two things that we gotta remember: no savings, right? So what we're gonna do, the strategies, we're gonna put our entire paycheck to a line of credit, and we're gonna take our expenses out and then rinse and repeat over and over again. Now let's just say, you know, we bought our home at the right time because sometimes timing is everything, right? I don't know if you ever heard that certain generations of people just happen to buy a house and then their $300,000 house magically turned into $1 million. You ever hear about those types of people? I know them, they're my parents, right? So maybe you bought a house for $200,000, and then because the market appreciated so much, you have something called equity. So if you don't know what equity is, all that is the home value minus the debts associated with the home. That's all it is, right? So if you were to put a for sale sign in front of your home, how much do you think you'd get? And the banks have ways to estimate that. They'll get an appraisal. They'll do something called pulling comps to estimate how much you can get for your home, right? And let's say we could actually get maybe $300,000 for our home. And so what we do is take the 300,000 minus 200,000, and we have $100,000 equity. Okay. Now, usually banks will loan you 80% of that. And here's the thing: if they see that you have all this debt, they probably won't lend you that much because, or they will probably deny you. Now, why is that? It's because banks don't lend you money when you need it, right? So anytime you need credit, you probably need to get it at a time when you don't need it. So, for example, I have $220,000 in lines of credit. How did I get that? I just applied when I didn't need it, right? and that's when banks will give it to you. And of course, you want to use it and make sure your accounts are active and all that. And again, I'm not giving you actual credit advice because I don't know your personal situation, but I'm just talking about generalities, right? This is for general information. But let's say that before we got all this credit card debt, we got a home equity line of credit for about $80,000. Okay, so think of this as a credit card kind of based on the value of your home and how much you can get for it and how much equity you have. So usually in my experience, when I've gotten two home equity lines of credit before. First one is like 15,000, second one was 50,000, and the first one I got was at like they had like a 0% introductory or something ridiculously low for like 6 months to a year. But we're gonna assume that we don't have that, right? So let's just say we have $80,000, okay? And first of all, let me actually mention this. Have you ever tried to explain velocity banking to friends and family? And the way that I would explain it, if I'm like explaining it to somebody completely new, is I would just show them this and just ask them, you know, hey, how do you pay off this debt easily without changing your lifestyle? How do you pay off this $60,000 of debt easily? Because look at this guy, he only has $254. And what's it going to do? Apply the $254 to like an extra credit card? Is it going to be that effective? Um, Maybe it probably will do some damage, but if you have zero here and you're putting that $254 here, um, I mean, it'll do something, but it's not. It'll still feel like you're living on the edge, right? So how can we easily pay this off without really changing our lifestyle? Now, given that more income is awesome, like you should always try to get more income and pay off debt. But okay, if you couldn't make more income, how could we easily pay this off? So what we're going to do is use our line of credit as our main operating account, and what we can do is just transfer all this debt or this debt right here, which is total of 60K to here. Okay, so 60,000, and guess what happens? All right, so if this is transferred just simply by transferring, okay, guess what? Our expenses just kind of magically decrease, and let's calculate our cash flow. C2 minus C3. Oh my gosh, so we went from this measly $250 left over to $2,300 of cash flow just in one swoop. Now I get it, some people aren't going to be always in this situation, but I'm saying there are plenty of people who overspend on their credit cards and debt, and they need the cash flow, right? And just by doing simple debt transfers, and again, there are rules about which debts to pay off first, and we talk about this in other videos like cash flow index and highest payment, lowest balance, and all that. But let's just make it easy for us just to kind of see the effect. We move these to the line of credit, and because we're putting our entire paycheck into the line of credit, that minimum payment for the line of credit essentially doesn't really matter except for the interest, right? But this is what we're going to do, okay? So what we're going to do is take this, so J2 minus our cash, actually, and let's do this, add the interest even though the interest is zero for the month zero because you don't get the statement balance, you only get it at month one, minus our cash flow 2308.9, okay? And then let's go ahead and calculate the interest for month one when you get the actual statement doing this. And again, you just get the average daily balance. So this average daily balance is not the same average daily balance as your actual statement because it's based on when you spend, but we'll just take the midpoint, multiply by zero point 0.1, which is the APR interest rate, and then you divide by 12, so you get the monthly interest, right? So banks charge you based on your average daily balance, and they actually calculate it by the number of days in the month. So some days have 28 days, 30, 31, and they don't just do divide by 12, but I'm just doing divide by 12 to make it easier on me. Okay, so now we have $57,000 of debt. So what we're going to use our cash flow and just keep going on and paying off this debt, right? So let's go ahead and see when this sucker goes to zero or red, right? And at this point, it's going to be completely paid off. Okay. Now, here's the thing. if you ever needed more money because of emergencies, maybe you have negative cash flow months, that's why the line of credit is there. Or even the credit cards, right? So the credit cards are a form of a line of credit, but what's really important is that we pay them off in full every single month. So if we do have months where we're not having the expected cash flow, but then maybe in other months, just because we don't have car breakdowns or anything like that, it's just going to be a few more months till we pay everything off. So you're going to delay the period of time, but this is going to help you really manage your cash flow without really let me say this, without really sweating. So let me go ahead and calculate this. L6 plus 1, and then I'm going to do Control C, and we'll see how many months it takes. So it takes about 30 months to pay off that 65K of credit card debt. And let's put that as our milestone, okay? So we're going to keep track of our milestones here, and then let me go ahead and make it a little fancy, simple. And then now, how much do we pay off? 65K in 30 months. Okay. Now, okay, so how many years is 30 months? So I'll just divide by 12. 2.5 years. Okay, so 2.5 years. And then what, right? So now we just pay off our mortgage. Okay, so let's go ahead and pay off our mortgage. And one of the things that we do when paying off our mortgage is um, because this has a lower interest rate than this, right? It's a little bit different when you deal with the mortgage. The mortgage in general, 99% of the time will be the last debt that you pay off, just because let's say you paid off this $200,000 mortgage. How much cash flow are you really getting back? Only about $1,100. Where it's like, oh, you pay off this 20,000, you get $700 back. So that's a much bigger ratio compared to the actual loan balance, which is why you want to pay off the mortgage last, right? Hope that makes sense. And usually when it comes to the mortgage, all you have to do is something called chunking. So what you do is just take kind of like your paycheck and then move it to the line of credit and then pay it off using your cash flow 2308 and then just repeat over and over again. So what do I mean by that? So let's say we have a 200K mortgage, and how many months are we at? So we're at 30 months, and we can actually calculate using a calculator, right? So we're going to use a calculator, maybe like Bankrate, amortization calculator, right? I like that one. I like calculator.net also. Actually, let me use the calculator.net. I like the ones without all the fancy bells and whistles. Amortization sometimes, because I think Bankrate might be a little bit. Um, I think sometimes I've had more difficulties using that than this one. This one's gets straight to the point. All right, so 200,000, 30 years, and after 30 months, so after 30 months right here, what's going to be the balance? 193K. All right, so let me just make this simple and then just say, hey, 193K at the 30 months. And here's the thing, how long do you think it will take to pay off like 5.5? So 193 minus 5.5. How long do you think it'll take to get to 187.5K if you just pay it according to the bank schedule, right? Just kind of keep paying it, little payments over the life of the loan. 185, where's 185? 185 is at the year of end of year 5. So let me just go ahead and go do this. So at the year of N5, take a look at this. 11,000 interest, 11,000 interest, 11, 11, 11. So that's like $55,000 of interest just to get to around 185, right? Isn't that insane? Like I the thing that really amazed me learning about all this stuff was just how mortgages worked. Like I had no idea how much interest you paid. And so when people are like freaking out about home ownership, it's like, dude, it's kind of overrated if you think about it. Unless you have a paid off home, right? But here's the thing, if you're in places like Los Angeles, Orange County, I don't know if you knew this, but it's always cheaper to rent than it is to buy a home. So if you're buying a home, you're paying an extreme premium for quote ownership. And since the average person moves like every 5 to 7 years, now I don't know if they do that in Orange County or LA, or if they could really afford to. You're just better off renting on a pure financial sense. All right, so let me go back here. So we see that it takes about 5 years to get around the 185K mark. Okay. Now, if we just do velocity banking and just kind of chip this, transfer some of this debt, right? So now let's say that we just transferred 187.5, 187.5, right? And then just move 5.5K to here. So let's just move 5,500, 5500. How long would it take to pay it off? Just 2 months, right? And so you just kind of repeat the process and then chip away the debt. And so what at this point, you're going to pay off your debt quickly by using your current cash flow. But at the same time, instead of directly using your savings, so let's say like, oh, I'll just directly put my savings into that mortgage. um, Guess what happens when you do that? You lose your liquidity, right? But the other thing too is that if you, let's say, use a credit card as backup, and I'm not saying this is a bad plan, right? If you use a credit card as a backup, what usually happens in my experience, or just human psychology, is that when you have when you're not putting your entire paycheck into one place, you're going to experience something called segregation of income, where eventually you're going to split your money and it's not going to be as effective as just putting it in one place, right? So maybe you have a credit card charge that you need because you dumped all your savings into mortgage. Now you have to pay two places rather than putting your money in one place. Now I know it seems like, mathematically it's going to be very similar, but it's kind of like what Dave Ramsey says, like, I actually prefer the debt snowball method than the debt avalanche, because if you do avalanche, yeah, mathematically it's going to be better, but you'll never do it. You see what I'm saying? Like so again, if you put your entire savings into that mortgage, that's not a problem, right? But just be aware of the segregation of income effect, and I go more into that in other videos. Now here's the thing. That let's say that I want a cheat sheet calculator, and luckily I do have that here. So I'm part of Renatus, and Renatus has, if you're a member of Renatus, they'll provide you this cheat sheet calculator. And if you want to join, go ahead and click the Google form link below, because you'll learn all the things that I learned here, and none of my ideas are actually original, to be honest. I didn't invent velocity banking. I just make YouTube videos about it. But um, I'm also an independent contracted marketer, so if you ever join because of me, I get a little bit of commission. So back to my point, they provide this calculator for being a student of Renatus, and I'm going to go ahead and put in the loan information. So it's $200,000. So what's the current balance after 30 months? We just take a look right there, 30 months, and I'll just copy and paste the exact value. So 193,573.01. Okay. And then we can use this as kind of like a cheat sheet to figure out how long it's actually going to take, a little bit more accurately than doing my cowboy math that I've done previously. And then, so what we're going to do is just put the line of credit. You could just put your paycheck amount. So for example, I think we're making 5,500, right? 5,500. And then we'll say 10% because we're going to use a HELOC. And what's our monthly income, right? So monthly income is 5,500. And our living expenses, right? What's our living expenses? Everything except the mortgage. So $2,000, because the mortgage is accounted for here. So let's go ahead and do that. So 2000. Whoopsie, something screwed up. All right. So 2000. Okay, we did that. And we paid off in about 5.5 years. Okay, 5.5 years. And then, so now let's just do this. So 30 divided by 12 is 2.5, 5.5. That's actually 8 years, right? So now we paid off 265K of debt in about 8 years. Isn't that awesome? Now we're completely debt free, and this goes to zero. And now look at that. So at this stage, we could just pretty much, you know, bathe in our extreme cash flow, because, the average person, if they had actually $400 of savings in a month, and they needed an emergency, there is a Federal Reserve study that said that they can't They can't make it. And here's the thing. Here's how you know people are struggling. I see so many compilation of TikTok videos of people in their 20s who are like, "Oh my gosh, I can't make it, blah 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 blah." And you know what? They're right because the system is set up for you to fail. I mean, the system is set up for you to be like this and then feel like you're going to freak out because you cannot, manage your debts. And this is a person who makes almost $100,000, right? So think about if you're at the 50, 60K mark, again, banks don't really lend you money if you have like a certain debt to income ratio, right? But it's important that we prepared when we do get debt that we have methods to pay it off easily so that we're not just making, let's say, minimum payments all the time, including our mortgage, and just wondering where our money went, right? Where did it go? Right? It just went, and that's why banks have the tallest buildings in every downtown, and they don't produce a real product. At least, as much as I criticize Apple, they produce a real product, right? There's an physical iPhone in your hand. Banks, what do they actually produce, and why do they have the tallest buildings? They just have paper, right? And that paper is really profitable because you're entering an agreement based on their terms, and nobody really knows what they're signing. Like, have you ever gone to a mortgage closing, right? And you read all the paperwork. There's so much paperwork. How it's like 200 pages. I don't know if it's 200 pages, but I remember it's a lot, right? And so somewhere in that huge documentation, there's always a section, and it's kind of, I don't know where it is, but it actually tells you like this is it called the TPI, total paid interest. Or is it called TAP, total interest paid? It's T something, right? And it tells you like, hey, for that 6% mortgage, you're actually going to pay $231,000 of interest for that $200,000 loan. So it's like almost 112% interest loan. And here's the funny thing, right? People sign documents that they don't understand all the time. But I understood what I'm signing, and I'm okay with it because I know that I'm what game I'm playing, and I'm able to pay off the debt quickly. You understand? Yeah, you get me, right? Or what I think what they say in you feel me. I don't know if that's a young person thing or an Atlanta thing. I don't know, but I used to I hear that a lot. Okay, so now, yeah, so that's pretty much it for today. This is our Saturday study camp, right? And if there's enough demand, who knows? I might make one in real life and charge an exorbitant amount. No, I'm just kidding. I probably won't because I'm too lazy. All right. So this is Korean Atlanta Mentorship. So if you're interested in joining our group, go ahead and click the Google form link below and send in your information. I'll get on a one-on-one Zoom call. Other than that, have a great day, and we will speak next time.